Well, people are focusing on the 5% numbers. I'd like to ask about a different number that he also mentioned, which is he thinks that it should be at 4% already. Is he right?
Well, there's no question the 10-year is being distorted by the ECB and the BOJ. Overseas pressures are pulling it down. The old-fashioned yield curve was really the market determined the 10-year and central banks determined the short rate. And you had a comparison of two different views. And today it's the central banks of the ECB and the BOJ that are really determining the 10-year. We saw that just a week or two ago when the BOJ suggested they were going to lift the cap on the JGB 10-year, and instantly the U.S. 10-year went up. So we don't really know if it would be at 4% or if it'd be just under 3%. We know it would be higher. This is a big topic. A lot of people are looking at the 2s to 10s. They're historically used to being that as their compass as to what the economy will be like and rate structure. And here you have the Fed themselves putting out a new paper saying, really look instead at this new portion of the yield curve, where the forward rates think the 3-month Treasury will be 18 months from now versus where it is today. Historically, they've moved in sync with the 2s to 10s, but at the moment, they're diverging. And this new curve is steepening, as Jamie suggests, and the traditional one still weighed down by the ECB and the BOJ. Now, what's interesting about what Mr. Dimon says is as we go through next year, the ECB will be taking their thumb off of pushing down the 10-year rates in Europe, and probably with a 6-month delay. So as we get into 2020, we're actually going to see where the 10-year should be. Fair to say no one knows other than higher.
And how rocky is that transition going to be? I mean, we haven't really seen very sharp moves in the bond market unless you go all the way back to the taper tantrum, right? You saw some volatility, of course, earlier this year, but not like we saw back at that time. Is it going to be difficult for people to navigate that? Is there a good strategy going into that to try and navigate it?
You're right. We saw it in '94, 2004. We saw a little hint of that earlier this year. But the very clubby bond market quite often predicts it'll never happen, as they did leading up to '94, 2004. And I think with this obsession over the 2s to 10s, despite all the papers and all the evidence. So, you know, it really depends on the backdrop. And we think that this is not a sugar high, that we have removed a lot of the downward depressants, post-crisis drags, and with them out of the way, private sector deleveraging, fiscal drag, with them out of the way, the pace of the global economy is accelerating. And that's one reason to believe that it will withstand kind of a higher 10-year and maybe not even do too badly, you know, for markets as you go through that. Rising rates, you know, have generally not been bad for a lot of markets until they get through sort of this neutral level that no one really knows where it is. You know it when you see it.